Dear friends, thank you for offering to listen to the subject and what I have to say. If I have made you think a little bit differently about the stock market, I would consider the presentation has done its job. So, before I start, I want to spend a slide talking about myself. I am Krishnaraj Venkataraman, called as Kimi, and of course, I think I look much younger than what my picture below suggests. I've been purchasing listed shares for the last 20 plus years, starting just before the Harshad Mehta scam. And I've been practicing the approach that I'm going to talk about for the last 12 odd years. I run business partnerships, investment partnerships. I basically do investment for a living and occasionally write in business newspapers. So, what I want to do is, I want to talk about intelligent investing for generating satisfactory returns. The key to note is satisfactory returns. We are not looking at outsized returns, we are looking at returns that one can reasonably expect over a long period of time. Now, I know many of you would have invested in the stock markets, and quite a few of you, I'm sure would have burnt your fingers just like I did when I started out a long time ago. And I've seen this repeat over and over again. The story goes somewhat like this: you have some cash that is left over that you want to make work, and it's there in your bank account, but not earning anything. So you decide to invest in the stock markets based on either some advice that you get from a friend, from banker, from investment counselors. Once the investment has been done, you have what is called an emotional roller coaster ride, which goes something like this. Starts with confidence when you've seen your portfolio rise up a bit and you extrapolate it to assume that it'll continue forever. But unfortunately, that takes a slight knock when the portfolio comes down and we feel nervous because we feel that, hey, that gets extrapolated down, and when it really does happen, then our nervousness turns to desperation because we now see that our portfolio is underwater, which means we have actually lost money, though not realized the losses. And that's if that stays on for quite a long period of time, which happens more often than not, we really get into despair and we think that the stock markets are not for us, it's for people who probably are gamble or are day traders and so on. Like, I want to highlight one example by sharing an email that I got from this close friend of mine, and of course I have taken his permission to reproduce this. It goes like this. The subject says, need your expert opinion. Though I should confess I'm not an expert, and in fact I take a dig at experts further down in the presentation. It goes, hi Kimi, need a help from you. Below, also attached, is a portfolio of 6 stocks that I've been holding for the last 3 to 4 years. From the time I had bought these, have only been declining and in the negative. Based on your knowledge of these companies, do you think I should book losses and sell them off? Or should I buy at current levels and try to average it out for the long term? Is there any merit in holding them given the levels at which I had bought them? Every day, seeing this loss of 75,000 rupees is hurting me. Either I write off and get rid or do something about it. Please share your thoughts, Kimi. And his portfolio comprises 6 blue chip stocks. In fact, quite a few of them are in the Nifty 50 and the Sensex. And they are down by about, his portfolio is down by about 60%. So it leads us to the next question, which is that is it possible at all to make money in the stock markets? And my answer to that is yes, it is possible, provided we carry the right expectations, the right temperament. And to convince you, I want to tell you that one of the most passive investors I know has made 16% per annum over the last 32 years. Rupees 100 that he would have invested in 1979 is about rupees 16,000. So you must remember a few things. One is that the returns are not quote unquote in the greedy land. The second is that you wait over a long period of time and let compounding work for you. So who is this investor and how does he do it? Well, his portfolio is simply a mirror of Sensex firms. Yes, what I'm talking about is essentially the Sensex. Now imagine someone who takes his capital, divides it into companies that constitute the Sensex in a ratio that's given by the Sensex, and all that is public information. And he does not do anything in his portfolio irrespective of what happens in the outside world, whether there's a stock market scam or wars or changes in economy policy or sovereign defaults and so on. He changes it only when the Sensex changes, which is about 2 to 3 times in a year. He's also informed of it well in advance, so it's not like he does it as a matter of surprise. So that's why I feel he does not apply any effort nor any intelligence to his portfolio, and so I say he's passive. And isn't it amazing that such a passive investor can earn such good returns? So this is how his stock would have performed, if he had stuck to it and not done anything. This is the time period that I've taken from Jan of 91 to Jan of 2012. You could see that while the stocks have moved up, there have been gyrations, quite wild gyrations of a drunkard's walk, I would say. So the next question is, if such a passive investment can make money, why can't we make money out of the stock market? And that's because, and this has been highlighted by various investors. First of all, Warren Buffett, he says that what we make up in intelligence, we often lack in temperament. And what I want to highlight is two of the most critical temperaments or attitudes, as I think is better to term them, which work against them. And I want to share with you what I think they are. The first one is that we often speculate when we think we are investing. So, what's the distinction? What do I mean by that? That precise definition was given by Benjamin Graham 78 ago in a book called Security Analysis. And I will read out to you, and I would urge you to reflect this on your own quote unquote investments. So, he says an investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. So we often follow an expert's advice, which I think is speculation. Just to highlight why I think so, let me share with you what their forecast was for Sensex in 2011 and where it ended at. And this is just one example of quote unquote an expert advice. These are the various fund houses. So I have about 9 fund houses giving their forecast. With the exception of Ambit Capital, which gives such a wide forecast so as to render forecasts unnecessary, most of them were off their mark by 30%. Now you can imagine that they employ the best of resources, the best talent, probably people with certainly much higher IQ than I have, and probably some of you in the room. But they were all off the mark, and surprisingly, they were all quite similar. So, which is why I say, expert advice is not a good advice. We often follow a gut feeling without being certain of the safety of principle. For instance, and don't tell me how often I would have done it in the past. We invest in a blue chip company without knowing if the price paid is too high, and an example will follow soon. We invest looking at recent price trends. If the price has gone up in the last 3 or 4 weeks or maybe 4 or 5 months and has gone down, suddenly we feel that we are going to reach the price that had been touched upon earlier. So we go ahead and invest thinking that the earlier price would be reached. And lastly, we invest in IPOs mainly for the fear of getting left out because everybody is doing it, and you don't want to be looking like, or certainly I don't want to be looking like a fool by not investing in the IPO and making good money. The second attitude that we carry, which is not right and which we may want to reflect upon, is that when we buy a stock, we do not relate the price we pay to buy the stock to its underlying business. In other words, we do not try to relate the price that we are paying to the stock to its intrinsic value of the business, and usually we end up paying too high a price. And if it's very high in respect to the underlying business, then there is really no safety of principle. And a fabulous example at one extreme is Infosys. For 9 years, it had, you could say, remained flat from point to point. And you would see that the company had really performed very well. In fact, the profits of the company grew by 20 times in the 9-year period, but the stock was flat. And the, clearly, the reason was the price in March 2000 was way above what was indicated by the underlying business. And so, all the time, the price fell trying to catch up with its underlying business, whereas the business actually grew till they probably converged sometime maybe in 2009. Actually, probably it was undervalued in 2009 Q1. Another extreme example is, where the price is far lower than indicated by the underlying business, in which case there is safety of principal and an adequate return. An example is a company called Patni Computers, which just about 3 years ago was selling at, actually 4 years ago, selling at less than cash in the company. Sorry, 3 years ago. So if you look at in Jan 2009, Patni Computers had the cash which amounted to about 110 rupees per share. It had no debt, and then it had this business, wonderful IT business, and surprisingly, the stock price was at somewhere between 80 and 100. So which means you could buy the entire company, still have about 10 to 30 rupees in the bank, plus get a business. Obviously, there is substantial safety of principle, and the markets realize that, and over the next 15 months, it grew by about 4 to 4.5 times. So these are some examples that tell you, how to look at a business, how to look at investments, the distinction between investments and speculation, and some of the attitudes that we carry which work against us. So I have been practicing this approach in my investment partnerships with satisfactory results so far. And I want to compare the result of my first partnership. The second partnership is also doing well, but the time period is too short to make any meaningful conclusions. If you look at my first partnerships, it's been running for close to 4 years now, and you could see how it does in comparison to the market benchmark, which is the Nifty. Um, and over the life of the partnership until March 2012, the Nifty had moved up by about 19.5%, whereas my partnership capital had grown by 54.1% by applying all the principles that I just spoke about in my presentation, and maybe some more. So, in effect, what I want to say is there is a way by which we could make satisfactory returns from the stock market, but we need to look at some of our attitudes and temperament before we approach it. That's all I have to say. If you are interested in knowing more about the partnership, then you can contact me. I wanted to thank Ramakrishnan for helping to arrange this, and in fact even helping me with my presentation a bit. And his address will be my local address, so you can feel free to write or contact there. Thank you very much.